All right, everyone, let's go ahead and get started. I just want to welcome everyone to this webinar on how to create a recession-resistant portfolio. Thanks for joining us here today. As we get started here, we're really excited to share this with you. Just to give you a little bit of background on who we are, Overland Capital is part of the Overland Group family. Really do mainly development, construction, capital raising. Been in business for over 30 years now as a vertically integrated company. A little bit about Overland Capital specifically. Overland Capital really was created to provide investors with a better investing experience. Everybody's heard that phrase, invest in what you know. Real estate is no different. So a big part of what we do is we help individual investors, self-directed retirement account owners, and 1031 tax-deferred exchange sellers invest in commercial real estate. So the more you know, trust me, the better investor you will be. Feel free to ask questions throughout the presentation, and we'll do our best to answer all questions at the end. For anyone who needs help locating that Q&A button, it's located at the bottom of your screen. Also, you'll be emailed a copy of this presentation, but you can view it on our website at overlandcapitalcorp.com and clicking on the education tab. A little bit about me. I run the investments and finance divisions of Overland Group. I spend a significant amount of my time working with equity partners and lenders. I'm also a licensed CPA. As I mentioned earlier, we have Ken Holman with us today. Ken is the president of Overland Group and has over 40 years of experience. He has developed over $350 million worth of commercial real estate. He also holds just about every top designation you can get in the real estate world. Let me turn it over to Ken to talk a little bit about himself.
Well, thanks, Mike. Great to be with you today. And I guess you'd say I'm the senior member of the group. I have had a lot of opportunities and both to attend some great schools and to earn degrees in accounting and an MBA, but I've also been able to get some of the most prestigious designations in real estate. But, you know, I think the most important education that I've received is my 42 years, if you can believe it, in the real estate business. A lot of this business is, you know, what you know and the experience that you gain. That really provides some valuable insights into real estate investing. And it's hard to overcome that with just education. You really, the experience helps you a ton.
Yeah, I have to agree with that. And so, Ken, I mean, we're talking about a recession-resistant portfolio here. Why don't you give us, I mean, you've had a little bit of experience with some recessions in the past. Why don't we start there?
Okay.
And we'll kind of move through this.
Sounds good. So our presentation today is about how to create a recession-resistant real estate investment portfolio. And since I started in business, I've been through about, I think, 7 recessions. And a couple of those have been really tough to go through. So I've seen friends that have invested in the stock market lose up to 40% of their retirement savings that they've spent a lifetime earning, and just do that in a matter of days, which could really be gut-wrenching. But we hope to give you some insights into the real estate investment side of the business, and I think that's going to be really helpful for you. So today, we're going to address basically 4 topics. First, we're going to talk about, are we in a recession? And then we're going to talk about how will a recession affect the current real estate values that are associated with real estate, obviously. Then we're going to talk about what real estate investments will perform best during these economic times. And finally, what you can do to better prepare yourself and your investments for the future. So let's start a little bit with where we are today. And although we may not have met the technical definition of a recession, which is defined as 2 quarters of declining GDP, the National Bureau of Economic Research, which is one of the major groups that follows recessions and the economy, they've defined a recession as a few months of sharp downturn in economic activity. And they've declared that the US is now in a recession as of mid-June. And that ended the longest run of growth we've had in history, which is pretty amazing, over 10 years. This is a landmark moment in the global recession that's obviously been caused by the coronavirus pandemic. And the US, being the world's #1 economy, has a great impact on what happens around the world and with real estate investing and stock market and everything else. The World Bank says that the global economy will experience a contraction of over 5% this year. That's pretty amazing. Fortunately, the stock market we thought was going to be lackluster for a long time, but it seems to have pulled back from the brink a bit with the S&P 500, which is the broadest index. It's pretty much recouped the 30% that it lost since mid-March, which is a wonderful thing. And the question probably isn't whether or not we're in a recession, but more importantly, what we can do to protect ourselves and position our investments for future growth. As Mike mentioned, and I think I mentioned, I've experienced 7 recessions, but 2 of which I thought were pretty bad, and that's during my lifetime. The first one was in 1987, on October 19th, 1987 to be exact. That was known as Black Monday, and the markets fell 20% that day. It was crazy. And that's during the next couple of years, that's when over 1,000 savings and loan associations failed, and the Resolution Trust Corporation, or RTC, was created, and they took over all the assets. That was a crazy time. And I built a new home during that time. When I started construction, interest rates were around 7%. When I finished and got my takeout loan, I closed it at 13% and felt lucky, which is
Oh my
crazy.
gosh, that's crazy.
So they finally topped out. This is the Jimmy Carter era, which most of you that are attending today don't even remember those times, but interest rates finally topped out at 20%. So, and then the second one happened starting in 2007. Most of you can remember that one. That was called the Great Recession. And later on, I'm going to tell you a little bit of a story about what we did to counter that recession. And that's really what got us going in terms of developing recession-resistant investments. So probably the scariest place to have your capital these days may be not in the real estate market, but in the stock market. The volatility index, or VIX as it's called, it's been all over the board the past several months. And in March, the stock market moved into bear territory with declines of 30%. Now it's back, but the question is for how long? So my son-in-law, he put all his money in a 401k account, and it dropped nearly 40% in less than 4 months, which I find to be extremely shocking. So we want to help you not have to deal with that. So fortunately, obviously, the stock market's pulled back from the brink, and the unemployment numbers, which are horrendous at the moment, but it looked like we were headed for 20% unemployment, but instead of losing 7.5 million jobs, fortunately, a few weeks ago, we gained 2.5 million jobs, and unemployment sits at about 13%, which is still alarming since unemployment stood at 3.5% just a few months ago. but that's kind of where we are. So let me turn it over to you, Mike.
Thanks, Ken. So this recession is very different than previous recessions, as I'm sure many of you are aware, especially the two bad ones Ken mentioned earlier. The biggest difference between this recession and past recessions is that this one was caused by a public health crisis, not the financial markets. So Jason Furman, if you don't know who he is, he's an economist, a professor at Harvard. He mentioned that we're in a self-induced recession, which is highly unusual in the US, and I would 100% have to agree with him. So there are a lot of debates among economists as to whether this recession will be U-shaped or V-shaped, but either way, most seem to agree that this is expected to be a relatively short recession and extremely unlikely to turn into a depression. That being said, this has been a huge wake-up call to many investors that they need some form of recession resistance to their portfolio. First off, let's make sure we understand what recession resistant means. Recession resistant doesn't mean that you're guaranteed to make tons of money during a recession no matter what. Recessions usually have widespread implications and no one is safe. But
that's too bad, Mike. I thought that's exactly what we were talking about, making tons of money during a recession. Sorry.
That's called a Ponzi scheme, and that's usually not what we're running here. So I'm just kidding. So anyway, sorry. So I want to point out though, there are some things that you can do to protect yourself and your money when recessions inevitably strike. When I say recession resistant, I mean investments that have a tendency to do better in downtimes than other investments. So don't worry, later on, Ken's going to get really, really specific into what real estate assets tend to do better in downtimes than other investments. I mean, after all, he has been through 7 recessions. Ken, how old are you again?
You know, it depends on the day. Some days I feel like I'm 120, and other days I feel like I'm 45 or 50. It's been a long time since I felt like I was 30, but so yeah, I don't have many gray hairs, which is pretty surprising, but yeah, I've been around for a while.
That's awesome. So when economic downturns hit, there's almost always a huge flight to safety. So in other words, people moving their money from perceived risky assets to perceived less risky assets. I emphasize perceived because we've been in commercial real estate a long time and have a lot of experience in this arena. And I have to say that risk is somewhat of a relative term with a lot of variables. But anyway, here are some of the safe investments investors tend to flock to during economic downturns. And really, they all have one thing in common. And that's that their returns are all horrific. I mean, honestly, look at some of the average returns you can expect on these. If you're serious about investing your money, these returns are abysmal, 1%, 1.5%. I remember a few years ago getting a CD at 3% APY, and I was thrilled.
Hey,
3%.
Mike. Yeah, so I went into Wells Fargo one day. This is when the last recession was going on. And I said, I've got 25,000 I want to put into a savings account. And they said, oh, we're going to put you in our super savings account. And then they told me that I was going to earn 1/4%. And I thought, what's super saving about that?
That's the issue that we see time and time again. So let's just say in this hypothetical world that you're lucky enough to find a 3% CD. Congratulations. So you've kept up with the average inflation rate since 2000 of 2.2%. Basically, your money is staying at the exact same buying power year after year. Now, I'm not saying that you shouldn't have some of these safe investments, but what I am saying is that if you are flocking every recession to these investments, there's a much better way. So like I said earlier, Ken's going to get detailed and specific about how and what real estate assets can provide you some recession resistance in your portfolio.
So there are businesses that do really well during economic prosperity, and then there's others that do better in times of economic uncertainty. Uh, the hotel business, I mean, these days, the hotel business, entertainment industry, the restaurant business, uh, those have been hit especially hard during this pandemic. But I expect that, in a few months or maybe several months, that they'll be back. And their values have been significantly affected because of most people being forced to stay at home. But as the economy improves, there may be some great opportunities in these industries sometime in the future. But today we're going to talk about two things that you must focus on to create a recession resistant real estate portfolio. First, you need to focus on investing in industries that are recession resistant. And I don't mean exactly investing in the industry itself. I mean investing in real estate that is leased to these industries. And then second, you need to pick real estate properties that tend to do well in a recession. So the businesses that are recession resistant fit into two categories. Uh, they either carry consumer staples like food and beverage and personal care products like toothpaste, soap, shampoo, things like that, or household goods like laundry detergent and toilet paper.
I was gonna say, I see the picture up here. We all know how toilet paper has gone over the last few months. I mean, I went to Costco a few days ago and saw a full shelf of toilet paper, and it was a miracle.
You were probably ecstatic.
I was. I was very, very pleased to see the toilet paper is back in stock. Sometimes over the last 3 months, maybe we should be in the toilet paper business instead of the commercial real estate business.
My gosh, maybe this presentation has gone downhill a little bit. I never expected we'd be talking about toilet paper when we're talking about real estate investments, but okay.
This is the first time I think toilet paper is found. There's a lot of things that have found their way onto these webinars.
Oh my gosh.
I think this is the first time toilet paper is one of them.
Mike, I'm moving on. So the other thing you need to focus on is another category is essential services. This includes housing and things like hardware stores, financial institution, transportation, manufacturing, construction, healthcare, and even essential government services. These are all housed in real estate investments, each of these things. So you need to focus on those things when you're getting a recession resistant real estate portfolio: consumer staples, essential services like housing, things like that. And so that brings me to my next point, that the three property types that I found that really do pretty well during a recession are discount retailers, and I'll describe that a little bit more as we go on, apartments, and self-storage projects. Any question why we're in those three specific real estate investment categories? We love these industries, and they each act a little bit differently, but some real estate investors don't realize that discount retailers make great tenants. When I say discount retailers, I mean not only the big box stores like Walmart and Costco and others, which are generally owned by investors and leased to these companies, but I also mean smaller retail stores like Family Dollar, Dollar Tree, Dollar General, Big Lots, AutoZone, O'Reilly Auto Parts, Walgreens, CVS, and there are a ton of others. But mainly what I'm talking about are national and regional credit tenants. They usually have strong balance sheet and a lot of cash, so they have the ability to weather these economic downturns. I've got to tell you that discount retailers may not be very sexy in terms of an investment, but they do extremely well during times of economic uncertainty. And there are some reasons for that. They, like I mentioned, they carry consumer staples. They increase in sales when consumers look for ways to reduce spending, uh, especially the national credit tenants. Many of them are Fortune 500 companies, and they have the ability to sign long-term double net and triple net leases. A triple net lease obviously being that they pay all the bills. And they also provide a consistent cash flow, even during a recession. So as we got into these types of properties, when the last recession hit, we were extremely pleased with the performance uh, of our property. So here's how you can expect, or what you can expect from these types of investments. You can expect a cash on cash return of somewhere around 4 to 6%, depending on the situation. You can expect some equity buildup of another 3 to 5%, and those numbers are return on investment, basically. And by equity buildup, I mean that the tenant pays the lease payments and you use the money to make your mortgage payments. So that pays down the principal on the property and that increases your equity. So they also provide a steady appreciation in value. And that's also another promising part of being able to get a decent return on investment. Well, with these investments, you can expect an increase in value over time as the lease payments increase. So doesn't happen every year, may happen depending on if you got annual escalations in the rent. If you don't, you probably have to wait a few years but they always continually just increase in value. So you can expect cap rates to run between 5 and 8%, depending on the quality of the tenant. For example, Walgreens, if you've ever looked at those as as a building you wanted to invest in, they're probably the safest tenant in this space, and their cap rates run about 5%. So you can expect that as the kind of the cap rate that you're looking at. Whereas if you get into the dollar stores, they're viewed at having more risk, and their cap rates run around 7%. Sometimes they'll even go up to 8%, depending on the situation and the length of the lease.
So one of the things, Ken, if you don't mind, I jump in here.
No.
One of the things I want to point out with these discount retailers is what your average overall return can expect it to be. Because that's a question we get all the time, right? I mean, we talk about all these pieces to what your overall return could be.
I think you can expect a return in the range of 8% to 12% on these investments.
Exactly. I think that's what we're seeing.
There are some others that may do better in non-recessionary times, but those are really solid returns when you're in a recessionary period, and that frankly beats the socks off a 2% CD. So,
hey, I got 3% one time.
Way to go! That was heroic. So, well, I mentioned earlier that I'd like to tell you a story about the Great Recession that happened in 2007. A few years ago, before that recession, we started buying and building discount retail stores. We owned several. And we converted a vacant Staples store located in Helena, Montana, which was across the street from a super Walmart. We converted that to a Big Lot store and had to add some square feet to it. It was 25,000 square feet. Big Lots wanted 30, so we were able to build another 5,000 square feet on the back of the building. But one couple came to me and they said, we have 200,000 in our IRA sitting in a bank account earning a 0.5% interest. And so I said, I think we can do better than that, but I don't want you to take all your money and put it in just this one investment. So we converted their IRA to a self-directed IRA or retirement account, and we took 150,000 and invested the money in the Big Lots building, which was owned by an LLC. And the year before they invested, they earned less than $1,000 in their IRA account. In fact, it was about 900 bucks. And the year after they invested with us, they earned nearly $12,000 on the 150 that they had invested. They went from 1,000 a year
Holy cow.
to 1,000 a month. It was crazy. It was awesome for them, and I was so excited for them. But that was a really good investment for them. And most discount retail investments don't throw off that much cash. We'd love it if they would, but depends on the situation. That situation, we were able to create some value, and it's turned out and still is a really great investment. So we're excited about that. I mentioned besides the discount retailers that apartments are good investments also when there's economic downturns. They usually do better when the economy is growing, but they don't do bad when the economy turns down. You may wind up, and you may have heard of this, that you might experience some additional vacancy and some credit loss because, you know, when people lose their jobs or move around and stuff, you're going to have some of that. But for the most part, apartments are historically sound investments, no matter which way the economic winds blow. So when times are tough, you know, often people need to move and they need to cut back on expenses. That leads to layoffs. It may lead to foreclosures. But all of those things, bad as they are, have a positive impact on the demand for rental housing. Housing fundamentals, basically, and not to get too into the weeds on this, but that relates to a person's hierarchy of needs. I know many of you have maybe heard of Maslow's hierarchy of needs. I was taught that in an economic class one time in the MBA program. But the first things you need food, you need shelter, you need clothing, you need water. Then you need security, you need friends and family. Well, apartments tend to fill all of these basic needs, and they represent about 20% of all housing in the United States. So as markets improve, population increases, you can anticipate that demand for apartments is going to continue to go up. And we've seen that in several of the markets that we're in. Most apartment syndicators, by the way, they scour the market looking for good apartment investments, and many do value add. That seems to be the catchwords of the day, but that market has really been picked over. And we're not opposed to these types of investments. In fact, if you can find one, they're terrific. But we generally prefer to build new. Building new obviously takes longer, and you have to endure the construction and the rent-up risk. But frankly, at the end of the day, they really create great long-term wealth. When you're finished, you wind up with a brand new asset, which is great, and you don't have to deal with any of the functional or economic obsolescence that exists. Meaning you can have a 9-foot high ceiling in your apartment unit instead of a 7.5 or 8-foot high ceiling. Just a bunch of things like that that exist. And times have changed. People's desires and habits and interests have changed with the times, and so building new allows you to also change that way. But really, if you build right, you can sell these assets for top dollar to institutional investors will pay a premium for the quality assets. Now, let me turn it over to Mike, if you would, Mike, for a second. Why don't you talk a little bit about self-storage investments?
Absolutely. So anyone who watched our previous how to invest in self-storage webinar probably remembers that I mentioned in that webinar that most experts agree that self-storage is fairly recession resistant due to the flexibility of the asset. Self-storage has proven that the industry can succeed in both economic upturns and downturns. People seem to continually find new and creative ways to use self-storage. So during an economic upturn, you might see people use facilities as product warehousing for small business or equipment storage for larger businesses. In an economic downturn, people are usually downsizing into smaller homes and storing household items such as furniture or art into a self-storage unit. So let me just prove to you a little bit about what I'm talking about as far as self-storage being fairly recession resistant. So during this current recession, we took all of our self-storage properties and analyzed what the occupancy decrease or increase was. When the pandemic started, we were understandably nervous about our self-storage assets because self-storage thrives on people moving around, and there was not a lot of moving around going on. But when looking at our self-storage portfolio that was currently in rent-up, we increased occupancy by 11% on average from the end of February to the end of May. 11% increase, that's amazing. So to be fair, we did see a slowdown on one of our properties, but that property was leasing up at 6 to 7% a month, and it's now more like 4 to 5% a month. On the other hand, we had a property that actually had decreased in occupancy the 4 months before February and has since had a 5% increase in occupancy.
You know, and one of the big points there that we have learned as we have continued to develop these assets, it's not only getting the right location, but there are some things that are really determining factors on how well these assets work, like not only the traffic count, but the right kind of traffic count. So there are just some little nuances that we picked up as we've continued to build this asset group. But if you have all your money invested in the stock market, you not only have to deal with the volatility of the market, but you also never have the opportunity to grow wealth using leverage. I'm sure you've all heard of that term. When you buy stock, for every dollar you invest, you buy $1 worth of stock. There's no leverage there. And when you invest in real estate, for every dollar you invest, you buy $4 worth of real estate. That means you have $4 appreciating in value, not just $1. Most financial planners and stockbrokers talk about asset allocation and diversification, and we could get into a whole discussion on that. But then they put all your money in the stock market, whether it's asset allocation or diversification. They pick a bunch of stocks, but they're all in the stock market. And so they don't diversify into real estate at all because they don't earn a commission on that. And a lot of the companies that they sell for preclude them from even suggesting that you diversify into real estate. But the one thing they don't do is they don't leverage your money. And to me, that's not a very smart approach. So I've learned over the years that I prefer to use a different investment model. I think you're making a big mistake if you don't have at least 50% of your investment capital invested in income producing real estate assets. And I don't mean real estate investment trusts called REITs. That's what most financial planners and stockbrokers suggest. But those aren't really real estate investments. They're stock investments that use the cash flow that they get from the real estate investments that they have to value the stock. So if you have your money invested directly in income producing real estate, when a recession hits, you're not staying up at night worried about what the stock market is doing and whether or not you just lost 40% of your net worth overnight. That's the thing I like about recession resistant real estate investments.
Yeah, I definitely agree, Ken. And I think it's important to understand how to adjust your portfolio to build in some recession resistance. I mean, while the 10% IRR you're getting in a discount store investment may not seem super high or super sexy to some, you better believe that 10% starts looking real good when a recession hits and everyone else has investments that are going negative and you're trucking along at your 10% return. So to wrap things up here, in order to create a recession-resistant portfolio using commercial real estate, you really need two things. One, you need to invest in industries that are recession-resistant, and two, select property types that tend to do better than others in a recession. So in our experience, those tend to be discount stores such as dollar stores, etc., apartments, and self-storage. And that's it, everyone. So please make sure to take the poll that pops up on your screens, as this helps us to get to know you better. We're going to go ahead and get the Q&A started as well. All right. Well, Ken, this might be our first webinar ever with no Q&A.
I think they all agree with us. That's awesome.
Everyone was just a little shell shocked, I think, from.
So, Mike, let me ask this question.
Yeah.
We talked about self-storage and our experience in self-storage. How good do you feel about those assets, really? Do you think they're recession resistant? I mean, I know we've had some positive experiences there, but are there other types of investments? Like, what about single family homes, or what about industrial properties, things like that? Would they be better investments, do you think, than self-storage or apartments?
No, I mean that's a great question, right? And so what I think of, right, if I were to group self-storage and apartments together, one of the beautiful things about those two, versus a single family home or versus some of these other assets that you mentioned, is that in any one of these assets, in one self-storage property, you're going to have 500 tenants, right? Or in an apartment, you're going to have 200 or 250 tenants in there.
Yeah.
And what that allows is if your one tenant in your single family home loses their job, you're done for, right?
You're 100% vacant.
You're 100% vacant. You have issues right from the beginning, right? And so kind of like what I said earlier, I mean, no industry is completely safe from a recession.
Right.
I mean, that's just the reality of the situation. If you have a perfectly recession-resistant asset, please call me. We will come up with a business plan and we will put this thing together. But in general, right, I mean, if you have 500 tenants in a self-storage facility or 200 tenants in an apartment building, well, you might have, 13% of those people lose their jobs. Well, you're still producing income, and most likely you're producing enough income, hopefully, to cover your cost, right? I mean, so you have a principal preservation there, right? I mean, investor capital is safe in those investments. I mean, it would take a lot. I mean, if you had a 500 unit self-storage facility, I mean, you'd have to lose 25-30% occupancy to probably not be able to just pay your mortgage payments. And so you can see there, I mean, you have this opportunity to spread it out. Now, that's on those two. If I were to move over now and talk about the retail, that one's all about industry, right? I mean, that's all about the business behind the real estate, right? I don't think that single I don't think that a single tenant building in and of itself is recession resistant, right? But it's who's the tenant and who's leasing that building, right? I mean, if you have a long-term Family Dollar lease on there, or Dollar Tree, or Big Lots, or one of these discount retailers, I mean, it's just been proven time and time again that when people stop shopping at Pier 1, I mean, we won't even talk about them and their bankruptcy, but when people stop shopping at these higher end stores, they turn to these discount stores like the Big Lots, right? I mean, they turn to the Dollar Tree where everything's a dollar. And so it's a little bit of two different aspects to each of those asset classes, but those are different things that each provide this recession resistance, this opportunity to still not to not lose money, but even make a little bit of money even during these times.
Yeah, and not, I might just add, not every one of those deals work out. I mean, we have a property that was a Family Dollar in North Salt Lake that I absolutely love the location of. And we bought it with only 4 years left on the lease. And when I bought it, I said to the investors, it appears that this store is very marginal. It's not getting the sales that they're expecting. And so, but I said, I love the location. I love the property. I think it's going to be a good investment. We may have to go through a release up of the asset. And sure enough, at the end of the day, 4 years later, I might add that I went to Family Dollar and I said, if you want, we'll let you out of the lease today. That was 4 years ago. They said, no, we want to stay. Well, they took it and converted it from a Family Dollar to a Dollar Tree. Nothing seemed to work quite well for them. So sure enough, they gave us notice. They've asked for an extension during this time, but we're going to release the property, and we're going to convert it into 4 tenants, each of them with 2,000 square feet. The first tenant I got on board is a dentist, and he's going to pay us 30 or 40% more in rent than the Dollar Tree was paying us. So, but we're going to have to go through the brain damage of kind of releasing the property and doing some remodeling and stuff like that. But at the end of the day, we're going to have an asset that was better than the discount store. So
yeah, I think that's a good situation and kind of shows how we can pivot. So we have some questions here.
Okay.
So Josh is asking, do you invest in mobile home communities?
Well, and the answer to that, Josh, is no, we don't. But we have found that those also are recession resistant, and those are good investments. But what I'm seeing is there are very few communities that want to build any more mobile home parks. They're doing everything they can to eliminate that asset class. They still exist. You can still find opportunities, but we find that asset class just keeps getting older and older over time, and there's pressure to eliminate them, especially by the communities. So let me say this, if you find a good opportunity to invest in a mobile home community, I would say you take a good hard look at it, because it's not a bad investment. And we don't do it because it's a lot of work to get one, and we feel like we can do better in some of the other asset classes. But yeah, they're not a bad investment at all if you can get one. And I know some guys that have invested in mobile home parks, and they've done extremely well with them. So yeah.
Perfect, thank you. So Bert is bringing up a good point here. He said, I don't like debt. I fully understand the benefit of leverage, but could there be circumstances that would be detrimental to an investment because of leverage, even with a low LTV? So I'll start with this one, Ken,
Sure.
if that's okay. So absolutely. I mean, anytime you get a lender involved, there's some amount of risk. But the thing to understand specifically with real estate is banks and lenders in general are very risk averse. They're not interested in losing their money. That's why when you go to a bank, their interest rates are lower than it costs to do the equity. But that's because they want to be guaranteed that their money comes back to them. So yes, is there risk? I mean, if you had a 200 unit apartment complex, everybody moves out, you couldn't pay your mortgage payment, and the bank gets a steal of a deal, and they come and foreclose on you. But the thing is a couple of things there. The lenders in general don't want your asset, right? They don't want it. And that's the biggest risk with having this leverage out is they come in, you can't make a payment, they take your asset. Well, 90% of them don't want it in the first place. So they're going to do everything they can to not take it and to help you succeed. And the other thing is the reason banks and lenders allow 75%, I mean, we've seen them up to 80, 85% leverage on these real estate assets is because they're viewed as less risky investments. At the end of the day, you have a physical asset that can be sold and generally cover anything, any of the payments or any of the loans that you need to make. So lenders who are about the least risk adverse people in the world are looking at this asset saying, I am happy to leverage this asset, 70, 75, 80% of the way. Because real estate in general is there's less risk on a leveraged asset than if you were to go leverage stocks.
Yeah.
Would you have anything else to add on that?
Yeah, there's a couple thoughts. There are three types of leverage: positive leverage, neutral leverage, negative leverage. As an investor, you want to only deal in properties where you can experience positive leverage, obviously. And what that means is, if you wanted to pay all cash for an investment, maybe you're going to wind up with 7 or 8% return. But if you do leverage, at least some leverage, and you don't have to get too aggressive on this, you could do 60% or so. But if you do some leverage, the banks are going to lend you money. I mean, we're getting quotes today at crazy numbers, 2.5%, 3%, 4% on properties that if we had no debt, we could earn 8%. But if you take a 4% loan and with a property that's could achieve 8%, and you're investing, say, 25% of your money into this thing and borrowing the rest, you're going to wind up with a 12, 14% return. I mean, it just supercharges your return. And so we're not opposed to leverage. And even in the worst recessions that I've seen, if you've got 25, 30% equity in a property, you're probably okay. And if the market is having a struggle with those kind of situations, as Mike mentioned, financial institutions will work with you. This COVID-19 thing that's happened, we have a couple properties with SBA loans. The SBA came back and said, we're going to pay your mortgage, your full mortgage for the next 6 months on both of your properties. And that was pretty awesome. And we've had other banks that have come back and said, hey, we're going to defer 2 or 3 months worth of payments. We know that some tenants are struggling and stuff like that. So you do get some help in those times. And you have to just focus on making sure you have positive leverage on your investment. So we're not scared of debt. But we are careful. We never try to over leverage. So
yeah, and I think that last sentence was probably the most important thing you said, right? I mean, you have to be smart and understand what you're doing. So okay, moving on here. Dylan said, great content, thanks for the information. Given COVID or the self-imposed recession, Are your investments faring differently right now based on their geographical locations? That's question one. Question two, can you speak specifically to Greater Salt Lake City?
Yeah, we can probably speak to both of those. Geographic location has some bearing, but we have national credit tenants and properties in places like uh, Fowler, Colorado, or Colorado City, Colorado, or Thermopolis, Wyoming, or Alpine, Wyoming, and those aren't great big metropolises, and those properties seem to be faring extremely well. Sometimes, like this one in North Salt Lake that we had, if you get a property positioned next to, say, a Walmart or something, Family Dollar doesn't like to go near a Walmart because they tend to be too big a competitor to keep up with them, and so they're very reluctant to go in a place that doesn't work. But you can, I find that Family Dollar, Dollar Tree, Dollar General, those companies are really smart on location. They do not want to go anywhere where they're not going to get a decent return and where they're not going to be successful. So you can almost count on that, not totally. In terms of the Great Salt Lake market, uh, I I know guys that will not invest in anything that isn't in a major metro area, and that's okay. That's an investment philosophy, but I think you begin to really limit uh, uh, your returns if that's all you're doing. I think you can invest in secondary and tertiary markets uh, and do extremely well in those markets. But you do have some risk. If they move out, it's tougher to release the property. But we've got one in Alpine that just they just renewed the option on the lease, and we've got one in Thermopolis where they're killing it up there. So uh, yeah, so the Great Salt Lake area, not bad. A lot of competition in this market, in the Salt Lake market. So it's just tough to find maybe some of your better deals, but they're still out there. So
Yeah, I agree. And just kind of point out that specifically, like, yes, so with this recession specifically, we're not, with the markets that we're invested in, which is mostly the Midwest, Utah, Arizona, surrounding states, stuff like that, we're not seeing a huge difference. That being said, it's not like we don't have any assets in New York,
yeah,
where they were going through that, or we tend to stay out of California for the most part. So some of these hotspot areas, specifically related to COVID, we haven't seen. They've all been pretty similar in how they fared through this.
we love to be in the West and the Intermountain West. Those states seem to be great states to invest in. So
Perfect. Okay, so we're going to go ahead and get things wrapped up here. Let everyone go. And that's all the questions that were asked this time. I did see one that we did respond to. Yes, you will be receiving a recording of this webinar. It gets emailed out. Also, you can view this webinar and any of the other webinars that we've done at our website. It's there on the bottom left of your screen, overlandcapitalcorp.com. You just go to the education tab. There's a bunch of articles, a bunch of webinars, everything from how to invest in self-storage, how to invest in apartments, understanding 1031 tax deferred exchange. So go ahead, check that out, and we appreciate y'all coming out this afternoon. Thank you.